Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our FSC show, so we're going to cover what's happening within the U.S., go through a bit on the natural gas curve because nat gas is exploding again, and then look abroad because we want to talk about Europe. You know, we did a lot in the econ show about the U.S., the U.S. dollar, Europe, and China. We just want to pull out some of the key pieces, especially talk about the US dollar for a minute at the end, like we did at the end in segment 1 and 2 of the econ show. So here you can see for the primary vision frac spread count is 280. So we had another decline of 5. Now it was fairly broad-based in terms of where the decline came, and it was a lot of one-offs. So one of the things, and I was talking to our CTO about this, my view was that we were going to start to get an upward move this week. But when we were talking, he was saying, look, you know, typically based on the things that we're seeing, the data that's been coming in, and what has happened in the past, it's really next week. So again, not to say that we're going to get this huge explosion next week of activity, but it's just that we should start to see that pivot in that trend back to about 295 as we get into September. And instead of, like, my initial view was that we were going to get to about 305 by the end of August. It's really looking like that's the likely outcome for the middle of September. So there's another 3 to 4 weeks before we really get to what we think is going to be kind of the peak number, about that 300 and 305. So for those that haven't seen, our article in AOGR has come out where we talk about Refracts, the opportunities that presents, and we have a whole report on it. So I'm sure that there's links within this segment, as well as on our website if you'd like to learn more about the Refract report. And there's more to come on that because we do think that there is a fairly sizable industry that is going to continue to build off of it. And I know in the past Refracts were one-offs. You know, you never were really sure if it was going to work, but just like fracking in general, people continue to make strides, new processes, new recipes, new ways of doing things, and you know, some of the data is very supportive of I think this becoming a more mainstream process over the coming few quarters. So now when we look at rigs, here you can see that the rig count horizontal was actually up by 1. Vertical was what actually drove the drop by 2, which is why the U.S. land was down 1. Again, the horizontal continues to go up, and that's what we like to talk about. Texas had an increase, New Mexico had a small drop. But again, the horizontal activity continues to be robust. And that's one of the things that we've talked about when we look at drilled but uncompleted wells. So the EIA released their data. Here you can see that the Haynesville DUCs continue to grow, which isn't surprising just given where natural gas is, where LNG is. And here you can see with the Permian starting to level off. Obviously the Anadarko also. Now, you can see the rate of change has really flatlined. Based on our data, some of these locations actually had small increases, but the EIA data had just a small decrease. So if you think about measuring DUCs and how the algorithm does it and how a lot of this is inputs, to have a small incline, small decline, again, we're coming into that margin of error where realistically, I think it's safe to say that things have flatlined. Now, as we get towards the end of the month with the completion activity coming down, rig counts remaining active, continuing to creep higher, this is where we're going to get that positive DUC count, and that's going to really carry us through that September and October push, which is where we're going to get to that 2.2 million barrel a day. Or, you know, get at this point, based on the fact that we're currently at 12.2, likely get to about a 12.3 million barrel a day exit rate as we head into 2023. Now, when you think about Refracts, and again, as you go, as a well ages, it tends to get lighter. Now, Refracts, again, completely dependent on the basin and whatnot. You can get another big increase in crude production. But a lot of times you also unlock some of the lighter ends. And in the past, that was a detriment because, who wanted natural gas? And I included the blue line, which is 3 years ago, who wanted natural gas at $2.50. Now that you have natural gas at $9.34, and if you just look through the curve, it's averaging close to $5.25. Well, now it becomes a very interesting proposition, especially when you think of LPG with propane currently sitting at about $1.10. All of a sudden, now there's an opportunity, and that's not going to stop because when you look at where we sit in the U.S. in terms of storage, where LNG currently sits, LNG at a record price, there is a lot of momentum to see a lot of these exports continue to remain robust. Now, and we'll talk about this on the EIA show next week in terms of the more strategic, deeper dive. But when we look at Singapore, Singapore had a build of 1 million barrels on the refined product side, and light distillate had a small drop, still at a record, a seasonally adjusted record, but again, trying to normalize as we've had some of those refinery run cuts as we've talked about. Middle distillate, small build, but still massively bullish position, and residual bouncing back up by a fairly wide margin. But this just brings you back to, flat. This is, I shouldn't say flat, but back to, let's call it the 15, 17-year average, which is what we think. Is light distillate's going to stay at a record high, middle distillate's going to stay at a record low, and residuals just kind of balance in between. And that's going to ebb and flow in general, where when you look at Europe, even though there's additional run cuts that have happened in the refining complex there, you have gasoline, which has had a big increase, another big increase in storage, and then gas oil, small increase, but still at a very bullish level, with fuel oil continuing to climb. But again, that fuel oil, we do see that heading into the east of Suez market. Now, when you look, and we'll talk more about this in terms of just underlying demand, European activity continues to flounder. U.S., we are now in the seasonal decline. There was a lot of schools that started August 1st, and then as we get through August, and then as you get to the first week or right after Labor Day, that's when everybody's quote unquote officially back at school. So we definitely have that working, and again, seasonally normal, nothing crazy. It's just, as we've been talking about in the EIA show, U.S. demand is seasonally below where we normally are, but again, the trend going down is the seasonal trend lower, just at a marked reduced level of about 400 to 600,000 barrels a day. Now, when you look at the LNG front, even with Freeport offline, here you can see there is still a significant amount of LNG heading offshore. The Freeport was given the clearance to restart in October at the levels that would keep their take-or-pay contracts fully intact. And again, it's just more positive news for U.S. LNG producers, U.S. natural gas producers, as the curve and obviously continues to be supportive. When you look at German power and French power, new records, it's just gone parabolic. This is just soul crushing when you think about inflation, PPI, CPI. Buying power of the European complex is just continuing to get completely just absolutely crushed, with Gazprom setting to shut the pipeline for 3 days in terms of Nord Stream for maintenance. But again, you're just seeing a lot of these pressure points. Some of this is fear, some of this is the view of rationing, but again, pressure is going to remain, and it's going to be supportive of LNG. And inflation is eroding purchasing power in the Eurozone consumer, which we talked about in the Econ show, but just highlighting that this number doesn't even include this huge surge in electricity prices, and then taking that to the next level, that number also doesn't include the most recent PPI, which is hitting an all-time high. Remember, PPI, Producer Price Index, is a leading indicator for CPI, because how do companies come up with their price? They look at their cost and figure out, taking our cost, looking at our margin, and how much of that can be passed through. And that's why you're going to continue to see price increases in Europe. The current accounts balance has now gone from a steep surplus to now a steep deficit just because imports going into China are down. So China's not buying for all of the reasons we described in segment 5. Imports of energy and electricity and everything else is through the roof. So you're getting, again, the pressure in Europe is just increasing exponentially. Now, when you turn to the U.S., job cuts are picking up, not surprising. Key findings from the recent PwC survey of 700 plus U.S. executives and board members is that 50% have reduced headcount or plan to, 52% have implemented hiring freezes, and over 40% are rescinding job offers. So again, you're seeing more pressure in the U.S. This is the data we were talking about when we were comparing non-farm payrolls, which were elevated in July, but July is usually a big month. It's usually a little bit of an overshot, and we do expect to see more pressure coming through as this is going to be a big overhang, which we'll again go deeper in next week. Now, when you look at the number of consecutive months of monthly leading indicator declines, leading economic index from the Conference Board has now contracted for 5 consecutive months, and it's rare to see this type of decline outside of recessions when looking back throughout history, which again points to where we see more pressure abound. Now, home price growth is cooling, but still strong relative to history. And this is what we were talking about. We did it. We did the Econ show yesterday on it, segment 3. We talked about it in the insights. There's just more pressure. But again, it doesn't happen all at once. And if you look at the parabolic move up, the move down is going to be strong as well, but you're going to stay elevated longer, which is going to keep CPI, that sticky inflation that we keep talking about, very elevated, with median price of existing single-family homes was up 10.6% in July. But that was down from the peak of 26.1 in May 2021, but still greater than pre-pandemic peak, which was in a range of 8%. So again, there's still more downside. There's still more pressure, and it's, again, slowly and then all at once, and we do see more downward movements based on everything that we outlined in segment 3 of yesterday's show. Now, just to call attention to the U.S. dollar, again, the dollar continues to move up. We do see it as a parabolic move to about 115. We made that call yesterday. It's now gone. It's now back over. It's over 108. This is going to be maximum pain when you look at the international markets, when you look at emerging markets, when you look at their purchasing power. This is going to increase interest expense for the dollar-denominated bonds, which again is going to be on top of the fact that this is the broadest tightening cycle in history. Now, it shouldn't be surprising given we had the biggest loosening period in history, but if you look at just the swing up, married with diesel prices at records, food prices at records, inflation remaining elevated across the board, electricity prices up, all the while you have the U.S. dollar just layering on more pain, which is why we do see more of an issue in terms of oil demand and demand in general as the pressure continues to mount on an international front as well, which is what we've been talking about. I know the Econ show was a bit long on yesterday, but we go through all of these different pieces in way more detail with more different supporting data sets along that. If you have any questions, again, you can find us in the comment section. You can email me, or you can find us on Twitter. So that's what we have for you today. Again, there's a lot of pressure points out there. Just given the natural spreads in ARBs, the U.S. oil exports are going to remain healthy. Even with the spreads, I mean, we're still $6 cheaper than Brent, which is, and it's and Brent right now is $5 more expensive than Dubai. So again, we're still very competitive, especially when you consider the Saudi Arabia and the Middle East pricing itself out of the market, given how expensive it is against Dubai. So U.S. activity is going to remain strong. We have the dollar strong, but we still have natural gas strong. We still have LPG strong and crude strong, which is going to maintain our activity and is kind of the best of both worlds. And then hopefully as construction slows and everything else, some of those input costs from labor, from pipe, from proppant starts to come down, and that'll increase some of the margin for some of these players. But we'll be following that as we continue on. So thanks again for watching. We hope you have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.